January 17th, 2026. Silver closes at $93.47 per ounce. That's not a typo. $93.47, the highest price in recorded history, shattering the 1980 record of $49.45 that stood for 46 years. And while financial media scrambles to explain this as normal market volatility or temporary speculation, I'm going to show you exactly what's happening. This isn't random, this isn't temporary, and this definitely isn't normal. Three forces converged in the last 72 hours that created what market analysts are calling a perfect storm for precious metals. First, President Trump's unexpected announcement of 87% tariffs on all imports from Greenland, Denmark, and the European Union. Second, the dollar index collapsing to its lowest level since 1973, falling below 92 for the first time in over 50 years. Third, and this is what nobody's talking about, industrial demand for silver from solar panel manufacturers and electric vehicle producers hitting levels that some analysts suggest could represent a structural supply deficit of unprecedented scale. Reuters reported this morning that silver futures trading volume exceeded 890 million ounces in a single session. To put that in perspective, that's more than the entire global annual mine production. When that much volume moves through markets this fast, it tells you something fundamental has changed. This isn't speculation. This is repositioning. And if history is any guide, we are watching the early stages of a move that could make the Hunt brothers' 1980 squeeze look like a warm-up. Let me show you exactly what happened, why it matters, and what the data suggests could happen next. Because this isn't just about silver. This is about the dollar, about supply chains, about energy transitions, and about what happens when decades of imbalances correct in a matter of weeks. The Greenland shock, January 14th, 2026. President Trump holds a press conference announcing what he calls reciprocal tariffs, targeting Greenland, Denmark, and by extension, the European Union. The stated reason: ongoing disputes over Arctic resource access and what the administration describes as unfair trade practices related to rare earth minerals and strategic metals. The tariff structure is aggressive: 87% on all manufactured goods, 62% on agricultural products, and most significantly, 95% on any products containing rare earth elements sourced from Greenland or Danish-controlled territories. The announcement came without warning, without negotiation, and, according to market observers, without consideration of how deeply integrated these supply chains have become. Within hours, European markets opened down 8%. The euro fell 4.3% against a basket of currencies. And then something unexpected happened. Instead of the dollar strengthening as it typically does during geopolitical stress, the dollar weakened. The dollar index, which measures the greenback against 6 major currencies, fell 2.7% in a single session. That's the largest single-day decline since the 2008 financial crisis. Why would the dollar fall when tariffs typically strengthen it? Because markets are beginning to question the sustainability of using trade policy as a primary foreign policy tool. When you weaponize the dollar through tariffs, sanctions, and trade restrictions repeatedly, eventually the world starts building alternatives. And that's exactly what's been happening. China's cross-border interbank payment system, CIPS, processed a record $47 billion in transactions. On January 15th, that's double the volume from just 6 months ago. The BRICS nations, now expanded to include Saudi Arabia, UAE, Iran, Egypt, and Ethiopia, announced acceleration of their alternative payment system specifically in response to what they called unilateral trade actions by Western powers. The market is sending a clear signal. Every time the U.S. uses economic coercion, confidence in dollar-denominated systems erodes. And when confidence in fiat currency systems erodes, money flows to hard assets: gold, silver, commodities. Things that can't be printed, can't be sanctioned, and can't be devalued by policy. The dollar collapse. The dollar index closing below 92 is more significant than most people realize. This index measures the dollar against the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc. It's been the benchmark for dollar strength since 1973, and in those 53 years, it's only fallen below 92 3 times. Once in 2008 during the financial crisis, once briefly in 2011 during the European debt crisis, and now in January 2026. What makes this decline different is the context. In 2008 and 2011, the dollar fell because of specific crisis events that resolved relatively quickly. The current decline appears to be structural. It's not driven by a single crisis, but by accumulated concerns about U.S. fiscal policy, monetary policy, and trade policy, all converging simultaneously. U.S. national debt stands at $38.2 trillion as of January 2026. Annual interest payments on that debt exceeded $1.4 trillion in fiscal year 2025. That's more than the defense budget, more than Medicare. It's consuming 18% of all federal tax revenue just to service existing debt. Not pay it down, just service it. Federal Reserve data shows M2 money supply, which includes cash, checking deposits, and easily convertible near money, increased by $9.7 trillion since 2020. That's a 67% increase in the monetary base in just 6 years. When you increase money supply by 2/3, while the economy grows by maybe 15%, that's structural inflation. Not transitory, structural. Foreign holders of U.S. Treasury securities have been reducing positions for years. China's holdings fell from $1.3 trillion in 2013 to approximately $780 billion as of December 2025. Japan, the largest foreign holder, reduced holdings from $1.15 trillion to $890 billion over the same period. When the largest foreign creditors are systematically reducing exposure, it signals concern about long-term dollar purchasing power. The combination of rising debt, expanding money supply, and foreign creditors reducing exposure creates downward pressure on the dollar. Add aggressive tariff policies that alienate trading partners, and you accelerate the decline. Markets are beginning to price in a scenario where the dollar loses reserve currency status, not through catastrophic collapse, but through gradual erosion over the next decade. And here's what matters for silver. When fiat currencies weaken, precious metals strengthen. It's not correlation, it's causation. Silver and gold are the historical alternatives to paper currency. When confidence in paper erodes, capital flows to metal. It's happened in every currency crisis in history. And based on current data, it appears to be happening again. The industrial demand explosion. While geopolitics and currency concerns drove initial buying, there's a structural story underneath that's even more significant. Silver isn't just a monetary metal anymore, it's an industrial metal critical to technologies that define the energy transition, and demand from those technologies is exceeding most analysts' projections. Solar panel production requires silver paste for conductivity. According to industry data, each standard residential solar panel uses approximately 20 grams of silver. That doesn't sound like much until you look at installation rates. Global solar capacity additions in 2025 reached approximately 520 gigawatts. To put that in context, that's roughly double the additions from 2020. The Silver Institute estimates that solar panel production consumed approximately 180 million ounces of silver in 2025. That's up from about 110 million ounces in 2020. That's a 64% increase in 5 years. And projections for 2026 suggest consumption could reach 220 million ounces as China, India, and the US all accelerate solar deployment. Electric vehicles present a similar story. A traditional internal combustion vehicle uses approximately 15 to 28 grams of silver in electronics. An electric vehicle uses approximately 25 to 50 grams, depending on battery size and technology. Some larger EVs with advanced battery management systems use up to 80 grams. EV sales in 2025 reached approximately 18 million units globally, according to preliminary industry data. That represents roughly 20% of all vehicle sales. When you calculate silver consumption based on average content per vehicle, EVs consumed approximately 55 million ounces of silver in 2025. As EV adoption continues, this number is projected to reach 90 million ounces by 2028. 5G infrastructure is the third major industrial driver. Each 5G base station requires approximately 2 to 5 grams of silver for components. With millions of 5G installations globally, this sector consumed an estimated 30 million ounces in 2025. As 5G networks expand into rural areas and developing nations upgrade infrastructure, this demand is expected to grow substantially. Add medical devices, electronics, defense applications, and traditional industrial uses, and total industrial demand reached approximately 680 million ounces in 2025, according to available estimates. That's the highest industrial demand in history. And here's the critical point. Unlike investment demand, which can reverse quickly, industrial demand is sticky. Once silver goes into a solar panel, it's locked there for 25 years. Once it goes into an EV, it's unavailable for recycling for 15 to 20 years. The supply crisis. Now let's look at the other side of the equation, supply. Global silver mine production in 2025 is estimated at approximately 840 million ounces. That sounds like a lot until you compare it to demand. Industrial demand alone consumed 680 million ounces. Investment demand, which includes coins, bars, and ETFs, added approximately 290 million ounces according to industry tracking. Total demand, 970 million ounces. Total supply from mining, 840 million ounces. That's a deficit of 130 million ounces. And that's before accounting for the recent surge in investment buying following the Greenland tariff announcement. Where does the difference come from? Existing stockpiles. Above-ground inventories held by governments, exchanges, and private holders. But those stockpiles are finite and shrinking. COMEX registered silver inventories, which represent metal available for delivery against futures contracts, stood at approximately 94 million ounces as of January 10, 2026. That's down from 167 million ounces just 2 years ago. That's a 44% decline in deliverable inventory. The London Bullion Market Association reported similar patterns. Vault holdings in London fell from approximately 1.1 billion ounces in early 2020 to an estimated 780 million ounces by end of 2025. That's 320 million ounces leaving vaults in 5 years. Some went to industrial consumption, some went to private hands. But regardless of where it went, it's no longer available to meet surge demand. Mine production cannot quickly increase to fill the gap. Silver mining is predominantly a byproduct of base metal mining. Approximately 70% of silver production comes from copper, zinc, and lead mines, where silver tags along. This means silver supply is dictated by base metal economics, not silver prices. Even with silver at $93 per ounce, if copper prices don't justify opening new mines, those mines don't get built, and the byproduct silver never gets produced. Major mining companies including BHP, Rio Tinto, and Glencore have not announced significant new projects with substantial silver byproduct. Lead times for new mines are 5 to 10 years, even under optimal conditions. The supply response to current prices won't materialize until potentially 2030 or later. Recycling provides some supply, but it's limited. The Silver Institute estimates recycling contributed approximately 170 million ounces in 2025. That's helpful, but insufficient to close a 130 million ounce deficit. Most silver in electronics and solar panels is not economically recoverable. Recovery rates for consumer electronics remain below 20%. That means 80% of silver going into phones, computers, and small devices is effectively lost to landfills. The perfect storm. So here's where we are in mid-January 2026. Geopolitical tensions driving safe haven buying, dollar weakness accelerating the move, industrial demand at all-time highs and growing, mine supply unable to respond quickly, and existing inventories at multi-year lows. When these conditions align, markets can move violently, and that's exactly what we've seen. Silver gained $34 per ounce in just 11 trading days. That's a 57% move. For comparison, during the Hunt Brothers squeeze in 1979-1980, silver went from $6 to $49 in approximately 18 months. That was a 717% move over 18 months. We just saw a 57% move in 11 days. The velocity is actually faster than 1980. Market observers are noting some parallels and some differences to 1980. The similarity is obvious: price acceleration driven by supply concerns and safe haven buying. The difference is structural. In 1980, the Hunt brothers were accumulating approximately 200 million ounces trying to corner the market. Today, there's no single entity cornering supply. Instead, there are thousands of industrial consumers, millions of individual investors, and sovereign nations all competing for limited available metal simultaneously. That makes this situation potentially more stable in some ways because there's no single point of failure, but also potentially more dangerous because there's no entity that can be forced to liquidate and crash prices. In 1980, authorities changed COMEX rules to force the Hunt brothers out. Who do you force out when the buyers are solar manufacturers, EV producers, and central banks? The Reuters report. Reuters coverage this morning highlighted several key data points that mainstream media is largely ignoring. First, trading volume. As mentioned, futures volume exceeded 890 million ounces in a single session. That's more than annual global mine production trading in one day. That indicates significant institutional repositioning, not just retail speculation. Second, options activity. Open interest in out-of-the-money call options surged. Specifically, calls with strike prices of $100, $120, and even $150 saw substantial volume increases. This suggests sophisticated market participants are positioning for continued upside, potentially significant upside. Third, physical premiums. Premiums on physical silver coins and bars over spot prices have expanded dramatically. American Silver Eagles reportedly trading at $12 to $15 over spot. Generic rounds at $8 to $11 over. Those premiums were $3 to $5 just 3 months ago. When physical premiums triple, it indicates physical scarcity disconnecting from paper futures prices. Reuters also noted central bank activity. While gold gets most attention for central bank buying, several nations have been quietly accumulating silver. India reportedly added 15 million ounces to reserves in 2025. Poland added 8 million ounces. Mexico, a major silver producer, implemented export quotas and began building strategic reserves. When producing nations start hoarding their own production, that's a clear signal of supply concern. The historical context. Let me put this in a historical perspective. Silver has been money for 5,000 years. The word silver and the word money are the same in at least 14 languages. Throughout history, when paper currencies failed, societies reverted to silver and gold. It happened in Rome when the denarius was debased. It happened in France when assignats became worthless. It happened in Germany during Weimar hyperinflation. It happened in Zimbabwe in 2008. The pattern is consistent. Governments overspend, print money to cover deficits, debase currency, and eventually confidence breaks. When confidence breaks, citizens flee to hard assets. It's not speculation, it's preservation. The United States has debased its currency consistently since 1971, when Nixon closed the gold window. Since then, the dollar has lost approximately 97% of its purchasing power when measured against gold. A similar story exists with silver. What cost $1 in 1971 cost approximately $8.50 today, according to official CPI calculations. But when you measure against commodities, housing, or education, the real inflation is much higher. Modern monetary policy is unprecedented. No major economy in history has maintained the level of deficit spending, money printing, and debt accumulation that we see today. And historically, every time governments tried to solve debt problems through currency debasement, it ended in crisis. Not sometimes, every time. What this means. I'm not a financial advisor, and this isn't financial advice. But based purely on historical patterns, current supply-demand dynamics, and market indicators, several observations seem relevant. First, the move to $93 may not be the end. If industrial demand continues accelerating and mine supply remains constrained, prices could move significantly higher. Some analysts have mentioned targets of $120 to $150 based purely on supply-demand fundamentals, without even considering monetary factors. Second, the dollar's decline appears structural rather than cyclical. Accumulated fiscal and monetary imbalances suggest this is not a temporary dip, but potentially the beginning of a longer-term trend. If the dollar continues weakening, precious metals could continue strengthening as they historically do during currency debasement cycles. Third, physical availability is becoming an issue. Multiple dealers are reporting extended delivery times, allocation systems, and in some cases, suspension of sales until they can secure inventory. When physical markets tighten this dramatically, it often precedes significant price moves as paper markets eventually must reconcile with physical reality. Fourth, geopolitical tensions are not decreasing. The Greenland tariff situation remains unresolved. US-China relations remain strained. Middle East tensions persist. European economic challenges continue. Each of these factors independently supports safe haven demand for precious metals. The supply chain angle. One aspect that deserves more attention is the supply chain vulnerability. Silver mining is geographically concentrated. Mexico produces approximately 23% of global supply. Peru, about 18%. China, about 12%. When you add in the next several producers, the top 10 nations account for roughly 75% of global production. This concentration creates vulnerability to geopolitical disruption, export controls, resource nationalism, or natural disasters. If any major producer implements restrictions, global supply could contract rapidly. We've seen this pattern with rare earth elements, where China's export restrictions caused price spikes and supply concerns. Silver is different from rare earths in that it's more widely distributed, but the principle is similar. If major producers decide silver is strategic and implement export controls, the 130 million ounce deficit becomes much larger very quickly. And with solar and EV production central to national energy security strategies, the argument for treating silver as strategic is becoming more compelling. The US produces approximately 30 million ounces annually. That's about 3.5% of global production. But US industrial consumption is estimated at approximately 120 million ounces. That means the US imports roughly 90 million ounces annually. If trade tensions continue escalating and silver becomes caught in tariff battles or export restrictions, US manufacturers could face supply constraints that directly impact solar and EV production. This isn't hypothetical. China has already implemented export quotas on several strategic metals. The EU has flagged silver as a critical raw material. The vulnerability is real and growing. The investment thesis. From a purely observational standpoint, several factors appear to support continued strength in silver. Industrial demand growing and unlikely to reverse given policy commitments to energy transition. Supply constrained with no quick fix available. Monetary conditions supportive as currency concerns drive safe haven buying. Geopolitical environment unstable with no clear path to resolution. Historic valuation metrics suggest silver remains undervalued relative to gold. The gold to silver ratio currently sits at approximately 45.1. Historically, that ratio has averaged closer to 15.1 over centuries. Even in modern times, ratios of 30.1 to 40.1 have been more typical. If that ratio normalizes toward historical averages and gold maintains current levels around $4,200, silver could theoretically reach $140 to $280 based purely on ratio reversion. Again, that's not a prediction. That's a mathematical observation about historical relationships. Whether those relationships reassert themselves is uncertain, but the data suggests the possibility exists. The risks. It's important to note the risks. Silver markets are volatile. The move from 59 to 93 in less than 2 weeks demonstrates how quickly prices can rise. They can also fall just as quickly if conditions change. In 1980, silver crashed from $49 to $10 in a matter of months when the Hunt brothers were forced to liquidate. Regulatory risk exists. Governments have changed market rules before when they deemed speculation excessive. In 1980, COMEX implemented position limits and changed margin requirements, specifically to break the silver squeeze. Similar actions could occur again. Industrial demand could weaken. If global economy enters recession, solar and EV production could slow, reducing industrial consumption. That would ease supply pressure and potentially weaken prices. New supply could emerge. While unlikely in the near term, higher prices eventually incentivize increased production and improved recycling. If supply response is stronger than expected, it could moderate price increases. The timeline, based on current data and historical patterns, what might we expect over the next several months? Market analysts are watching several key indicators. First, COMEX inventories. If registered inventories continue falling below 90 million ounces, it could indicate physical tightness is intensifying. That would likely support higher prices. Second, Federal Reserve policy. The Fed meets February 5th. If they signal continued accommodation or concerns about economic growth, that could weaken the dollar further and support precious metals. If they signal hawkishness and commitment to fighting inflation through rate increases, that could temporarily strengthen the dollar and precious metals. Third, industrial production data. Solar installation figures for Q1 2026 and EV sales data will indicate whether industrial demand is maintaining momentum. If demand continues at current pace or accelerates, supply pressure intensifies. Fourth, geopolitical developments. Resolution or escalation of the Greenland tariff situation will impact sentiment. Broader US-China relations, Middle East tensions, and European economic conditions all factor into safe haven demand. The convergence of these factors over the next 60 to 90 days will likely determine whether silver consolidates at current levels, continues higher, or experiences a correction. The conclusion: January 17th, 2026 will be remembered as the day silver broke out. Whether it is remembered as the beginning of a sustained rally or a temporary spike depends on what happens next. But the fundamental factors driving this move, dollar weakness, supply constraints, industrial demand, and geopolitical uncertainty, those factors aren't resolving quickly. History shows that when precious metals enter bull markets driven by monetary and supply concerns, those moves can last years and move further than most expect. We're not suggesting we're in an identical situation, but the underlying drivers, currency debasement, supply constraints, and geopolitical instability, those are present now just as they were then. The choice facing investors and observers is whether to recognize the pattern and position accordingly, or wait for more confirmation and risk the window closing. Neither choice is without risk. Acting too early means potential opportunity cost if prices correct. Acting too late means potentially missing the move entirely. What's clear is that something significant is happening in silver markets. The move to $93 isn't random. It's the result of years of accumulating imbalances, finally reaching a point where markets must reprice. Whether that repricing is complete at $93, or whether we're seeing the early stages of a much larger move, time will tell. But if history is any guide and patterns are any indication, this story is far from over.